Okay, so back to where we left off. We are on slide 10 of deck 6, and we were talking about dividend integration. And I think last week we talked about the theoretical framework for dividend integration. We also talked about how corporate distributions get taxed when the distribution is debt. And I think we had earlier in the course as well talked a little bit about options and share issuances as well, just to complete that circle. So now that we have this understanding of how things are supposed to work as a policy matter, we can turn our attention to how things actually work as a technical matter in this area. So to slide 10 of deck 6, we're going to start talking about, first on this slide, non-eligible dividends. So what we have with non-eligible dividends, they can also be paid by non-CCPCs, but they're primarily the default dividend payment type for CCPCs. And for this purpose, a CCPC can elect to be a non-CCPC under paragraph D of the CCPC definition in subsection 125.7. So when we're distinguishing between CCPCs and non-CCPCs and talking about dividend types and pools from which dividends are paid, please do keep in mind that a corporation that could be a CCPC but has elected to not be a CCPC is, for this purpose, not a CCPC. So this is one of the purposes where the paragraph D election does actually have some meaningful effect. The other thing to keep in mind as well is that this dividend integration system that we're going to talk about only applies to residents of Canada, who are individuals resident in Canada, obviously including trusts. It does not apply to either non-residents or to dividend recipients that are corporations. I think we've talked at least a few times now about how corporations, we have a subsection 112.1 deduction. And so as a result, corporations get taxed a little bit differently. And for non-residents, what we're going to see is, we're going to talk about this a little bit more as well. I think just that we don't really care about integrating corporate tax and personal tax for non-residents. That's the foreign jurisdiction's job. So Canada doesn't really have any role to play in doing that. And so we don't have a similar mechanism for non-resident shareholders. So with that, we can talk about dividends themselves a little bit. For our purposes, there's two types of taxable dividends, which we care about, which are called eligible dividends and non-eligible dividends. For CCPCs, like I said, non-eligible dividends are the default. And these are dividends that are effectively traceable to the small business deduction eligible income of the CCPC, or that are traceable to the investment income of the CCPC, other than dividends received from another corporation that were designated as eligible dividends. Aside from those things, like I said, that will be the kind of the conceptual basis for the income from which a non-eligible dividend would be paid. What we're going to see as well with non-CCPCs is that non-CCPCs maintain a balance called an LRIP pool, which we're going to talk about in a couple slides. And to the extent that a non-CCPC has an LRIP pool, it will pay non-eligible dividends as well. And so it's not purely a CCPC concept, but by and large, non-eligible dividends are relevant where you have individuals who are shareholders of a non-CCPC. So with that aside, we can now shift to the actual technical requirements for taxing dividends, which are what you see on the slide. So the first step is to cause the actual dividend to be included in income. So this is the amount that the corporation declared in the resolution of the directors causing the dividend to be paid. So that amount gets included in income under paragraph 12.1J and paragraph 82.1A. So far, so good. Okay, and then what happens is to actually accomplish integration, we then have a gross up for the amount of the dividend received under subparagraph 82(1)(b)(1), which again you can see on the slide, and that gross up is equal to 15% of the non-eligible dividend received. So just to, I guess, to mention why we do this again, the 15% gross up, the idea there is to compensate the share, well, as part of the gross up and credit process, is to compensate the shareholder for the corporate tax paid. So the idea here is that the actual amount of the dividend plus 15%, once you've like that should account for the amount the shareholder would have received, but for the corporate tax, or at least that's what's intended to approximate. Obviously, this isn't perfect. And then we take things from there. So once we've caused our grossed up dividend to be included in income, then we will have to compute tentative tax payable on that grossed up dividend. And so the way you would do that is just take the 115% of the dividend actually received, and then multiply that by, in our case, the top marginal rate, because we're going to assume in this course that every individual taxpayer, unless we very clearly specify otherwise, is a top marginal rate taxpayer. And so in Alberta in 2021, that top marginal rate is 48%. So we're going to multiply our 115% of the dividend received by 48%, and that gets our tentative tax payable. Okay, next, what we do is we will then apply the federal dividend tax credit in paragraph 121A. And this credit is equal to, I'm going to pull up my act because it's actually a fraction that nobody uses. So in taxation years 2019 and onwards, which includes 2021, the federal dividend tax credit, which is allowed as a reduction of tax, is equal to 9/13 of the 15% grossed up portion of the dividend. So effectively, that's 9.03% of the dividend, which is what you see in the slide, is allowed as a credit against tax. Then what we would do as well is we would apply the Alberta credit. And again, this is one of those things where you have to look up the fraction every time. The Alberta credit is in paragraph, the Alberta credit is in paragraph 21C1 of the Alberta Personal Income Tax Act. And that credit is equal to the fraction 149/890, which should compute to 2.18% of the tax payable, sorry, of the amount of the dividend rather, that's allowed as a credit against tax payable. So again, that's to apply the Alberta credit, it's 149/890 multiplied by the grossed up portion of the dividend. So multiplied by that additional 15%, and that's where you should be getting 2.18% of the dividend that was included in income. And so if you've done all of that right, you should be coming to a effective tax rate on the non-eligible dividend income of 42.31% in Alberta in 2021. Obviously, that rate varies from province to province. So that is non-eligible dividends. Is everybody broadly okay so far?
Could you possibly go over the gross up part again?
Yeah, absolutely. So the gross up is in subparagraph 82(1)(b)(1). And the way the gross up works is that you not only include in your income the amount of the dividend received. So say the corporation pays a $100 dividend on its shares that you own. You would include in your income by default under paragraphs 12(1)(j) and paragraph 82(1)(a) the $100, and then you would add to that the gross up amount in subparagraph 82(1)(b)(1), which is 15%. So you would have total income in respect to the dividend of $115. And we have a question in the chat. Just to clarify, both the federal and provincial credit apply to the gross up portion of the dividend and not the whole 150%. Yeah, that's right. So the way that the fractions work is you multiply the 15% of the dividends, whatever number is 15% of the dividend, which is the gross up portion, is multiplied by the relevant fraction, whether it's 9/13 in the Federal Act or whatever the ridiculous number in the Alberta Personal Income Tax Act is. And so that's it. And then that gets you your credit amount, which should be the amount on the slide. So if you have the federal number where it's 9/13, that should be 9.03% of the 115%. And if you have the Alberta number, it should be the 148/890 multiplied by the 15%, which should translate to 2.18% of 115% of the dividend.
I just have a quick question. I think I'm getting eligible and non-eligible dividends messed up in my head. So a non-eligible dividend is from like SBD, small business deduction eligible income. Is that correct?
Yes.
Okay.
Which I recognize is confusing, that the eligible dividend is from non-small business deduction eligible income effectively, but yeah, that's right.
Okay, thank you.
No problem. Anybody else before we move on? Okay, seeing none, then we can move on to our next slide, which is slide 11 of Deck 6. And we can now talk about eligible dividends. So, as I mentioned and otherwise implied on the last slide, when you have a non-CCPC, the default is that the non-CCPC pays eligible dividends. And eligible dividends are effectively dividends that can be sourced to general rate business income. So anything that would fall into full rate taxable income as defined in section 123.4, that is effectively going to be the underlying income from which eligible dividends get paid. So we have I guess before we just move on with that, I think that the important thing to mention is that non-CCPCs, as I say, pay eligible dividends by default generally. CCPCs can pay eligible dividends as well, as we're going to see in a couple slides. To the extent that a CCPC has business income in excess of the small business deduction, it's going to generate a pool from which it can pay eligible dividends. So CCPCs, especially high earning CCPCs, will have eligible dividends as well. So if we're going to then move through the process of taxing eligible dividends, again, our starting point is the same. We're going to include in income. Under paragraph 12(1)(j) and paragraphs 82(1)(a) and 8.1 the amount of the eligible dividend. So again, if the corporation declares a $100 eligible dividend, then you include in income $100, right? So fairly simple so far. Then we have a gross up, again, just like we do with non-eligible dividends, but the amount is different. So first of all, it's a different subparagraph. It's subparagraph 82(1)(b)(2). But like I said, the amount is different. So in 2021, the gross up in subparagraph 82(1)(b)(2) is 38% of the amount of the dividend otherwise included in income. So if the corporation paid a $100 dividend, the gross up would be $38, and so you'd have a total income inclusion of $138. So again, after that, you would take that 138% of the dividend actually received, and you'd compute tentative tax payable by multiplying that amount by the 48% top marginal rate, which would give you an amount of tax payable prior to applying the dividend tax credits. And then you do apply the dividend tax credit. So in 2021, the federal dividend tax credit is in paragraph 121B, and it is equal to 6/11 multiplied by the gross up amount, which again, as on the slide, that should be a 15.02% of the dividend as your credit if you've applied that number correctly. And then there's the provincial credit, which if we just pull that up here, is in subparagraph 21C2 of the Alberta Personal Income Tax Act. And that is equal to, again, this is a weird fraction, 227/770. And that, again, should work out to 8.12% of the dividend that was included in income, which is what you can see on the handout, or on the slide rather. So I think there's actually a misprint on the slide. It references paragraph 21H. Paragraph 21H was actually would have been repealed in 2020 and was replaced with the now subparagraph 21C2, which probably was a smart move, as obviously I don't think any of you have had to look at the Alberta Personal Income Tax Act before, but what was happening was that every year as there was a change to the general rate, or as there was a desire to change the dividend tax credit because there was a change to the personal rate as well, or if we were in 2015 to 2019, there was changes to personal rates, but no corresponding change to the dividend tax credit rates. The Alberta legislature would just add another paragraph onto section 21. So it just started off as section 21 saying, like, the dividend tax credit is X, and then it just became, a whole bunch of new paragraphs. So instead, in 2020, they just repealed all those prior paragraphs, and now they just have A, B, and C, and B was in fact repealed as well. So now it's just A and C. So again, if you've done all of that right on eligible dividends, you should have an effective tax rate in Alberta in 2020 of 34.31%. So that's eligible dividends. Did anybody have any questions on that before we moved on?
Hey, Professor Dolson, do you mind just going over how you get the 34.31%? Because I realize I was doing it wrong now, but I was originally taking the 48% and then subtracting what the overall credit would have been to get what I thought would have been the effective personal rate.
Yeah, I mean, and that's what you're not subtracting from the rate, but you're subtracting it from the tax payable. So what you would be doing is you would be so you would be computing your tentative tax payout. So it would be, in our example, let's say with an eligible dividend where it's 138% gets included in income, you would compute your tentative tax payable as 48% of 138% of the dividend received, and then you would compute your credit amounts, and you would actually subtract the credit amounts from the tax payable, like that tentative tax payable amount.
Okay, perfect. Thanks.
Yeah, no problem. Anybody else? Okay, seeing none, we can go to slide 12. And slide 12 and slide 13, we're going to talk about the pool concepts that determine when you can pay and if you can pay which type of dividend. So we'll talk about GRIP first. And so GRIP is a pool that is maintained by CCPCs and only by CCPCs. And it determines the amount, if any, that the CCPC can pay as an eligible dividend without bad things happening. Like in theory, the Act allows you to designate a dividend as an eligible dividend anytime you want, but bad things happen if you overpay eligible dividends that aren't backed by GRIP, which we'll see in just a moment. So GRIP, for our purposes here, we can work with a simplified definition of what GRIP is. So the starting point for GRIP is that it's an end of year calculation. It's not a point in time calculation, which is mentioned on the slide. And so your starting point is always your ending GRIP balance at the conclusion of the last taxation year of the corporation. So whatever that number was is going to be your opening GRIP balance. And then you're going to start adding amounts to the corporation's opening GRIP balance. So the first and generally most important one for CCPCs is 72% of the adjusted taxable income. And so the way that actually works, if you look at the GRIP definition in subsection 89.1, is it's the corporation's adjusted taxable income, which is effectively the CCPC's business income in excess of its small business deduction amount and in excess of its aggregate investment income, multiplied by the general rate factor, which is again a defined term, and that's defined in subsection 89.1. And right now the general rate factor is defined as 72%. So effectively 72% of the corporation's full rate taxable income gets added to its general rate income pool. So that's the important part. And then the other one that may be significant, as an addition to the general rate income pool, is the corporation's, are the eligible dividends that were received by the corporation in the taxation year from another corporation. It doesn't matter whether the corporation is connected or not, just so long as the dividend it received was an eligible dividend. So those two amounts are the main drivers for a CCPC's GRIP. Like I said, there's several others that can go in there. For example, deductible dividends from foreign affiliates, which those of you who are taking international tax for apparently the last time, we'll get to learn about that. But that's the kind of the basics of the GRIP additions. And then all eligible dividends paid in the year are subtracted from GRIP. And then whatever you're left with opening GRIP plus 72% of adjusted taxable income plus eligible dividends received from other corporations, less eligible dividends paid in the year, that's the corporation's GRIP at the end of the year. So that's how you do it. What I think is kind of, hopefully screaming out at you from that is that, when you pay an eligible dividend, you are kind of doing it on faith, right? Because if you're not immediately before the end of the year, you're obviously banking that the corporation is going to have enough GRIP at the end of the year that you're going to have an amount above zero, or at least equal to zero when you run through that formula, including the eligible dividend that you are currently paying in the year. So, and we'll see in a slide or two, what kind of incentives that leads to. I think you can probably imagine, right, as you're sitting here, imagine what incentives that leads to. So that's GRIP. Did anybody have any questions about GRIP? Okay, seeing none, we can flip to slide 13. And slide 13 is dealing with LRIP. And so LRIP is a pool. It's kind of the opposite of GRIP, but it's a pool that's only maintained by non-CCPCs. So this is an irrelevant concept for CCPCs. And what LRIP does for a non-CCPC is it effectively requires the non-CCPC to pay non-eligible dividends until its LRIP balance is exhausted, at which point the non-CCPC can resume paying effectively unlimited eligible dividends. So like corporations paying eligible dividends where there's no GRIP, if it's a CCPC, similarly, a non-CCPC can pay eligible dividends even if it has LRIP. There's not actually a mechanism that says, thou shalt not in the Income Tax Act, but again, as we're going to see, bad things happen if the non-CCPC pays an eligible dividend at a time when it has an LRIP balance. And so the result is that nobody, in fact, does that, right? Because it's self-defeating. There's no reason you would ever do it. So moving on to the elements of LRIP, again, LRIP is a defined term in subsection 89.1. We're going to talk about some simplified portions of the LRIP definition, again, because there's only Seven's asking, can I go over the mechanism for LRIP again? And yeah, so like I said, LRIP is it's a pool concept, just like GRIP. It's maintained by a non-CCPC, so only a corporation resident in Canada that is not a CCPC would maintain an LRIP balance. And effectively, the way LRIP works is that if a corporation that is not a CCPC has a positive LRIP balance at any particular time, bad things happen if the corporation pays an eligible dividend. So effectively, what we're going to see is that non-eligible dividends reduce LRIP. And so effectively, what having LRIP does is it functions as a blocker, and that the corporation is going to have to pay non-eligible dividends until it has exhausted its LRIP. So that's what LRIP is intended to do. Mechanically, as you'll see on the slide, it's different than GRIP. GRIP was an end-of-year calculation. LRIP is a point-in-time test. So at any moment in time, you either have an LRIP balance or you don't. And you should know if you have an LRIP balance or if you don't at that point in time. So then turning back to our constituent elements of LRIP as defined in subsection 89.1, it's somewhat easier to do the simplified definition than it is with GRIP. But the basic calculations, you have your LRIP from the end of the last taxation year, which may be zero, may not be, but it may be zero. And then you would add the non-eligible dividends received to the LRIP. And again, those get added at the point that they're received. And so if you have a non-CCPC that receives a non-eligible dividend, it will immediately have an LRIP balance if it didn't already have one. If it did already have one, the LRIP balance is going to go up by the amount of the non-eligible dividend received. If the corporation is a CCPC that has elected not to be a CCPC, so again, under paragraph D of the CCPC definition in subsection 125.7, then the corporation has to add to its LRIP an amount equal to 80% of the corporation's aggregate investment income for the last taxation year to end immediately before the particular time. And as well, and this is kind of a weirder adjustment, if the corporation is not a CCPC and was not a CCPC in its prior taxation year, but was entitled to claim the small business deduction in a taxation year preceding the preceding taxation year, then it has to add an amount to its LRIP that accounts for the value of the small business deduction. I don't really have a good example of how that works. And honestly, I have worked on enough files where we have converted CCPCs into non-CCPCs and had to deal with LRIP additions, and we have never once had an addition under that part of the definition. So it's something to know that's there, but it's pretty difficult to see how it would ever actually compute to an amount greater than 0 as your addition, especially because generally speaking, people are not going to cause corporations that are still claiming that small business deduction to cease to be CCPCs, or if they are, it's because they're being acquired by usually a public corporation, and it becomes the public corporation's problem to sort out that issue anyway with the LRIP. So, think about that. Think about the fact that it's there. It's interesting. Again, not highly relevant, not ever going to examine you on it, and not actually, in fact, sure how in the real world you could come up with a situation where it computes to greater than 0. And so from all of these amounts, then, your opening LRIP plus non-eligible dividends received plus 80% of aggregate investment income for the last taxation year ending before the particular time, you subtract any non-eligible dividends that were paid by the non-CCPC in the year and immediately prior to the particular time. And so that will give you your LRIP balance at the particular time. So that's LRIP. Again, anybody have any questions about LRIP before we move on? Yeah, Leah, go ahead.
So I just want to clarify before we move on. So GRIP is basically like the default for non-CCPCs is they pay eligible dividends, and the default for CCPCs is they pay non-eligible dividends. But for the balance that is in LRIP for non-CCPCs and GRIP for CCPCs, is that correct?
Yeah, that's basically right. So I think the way I would phrase this is non-CCPC, sorry, let's just start with CCPCs. CCPCs can pay eligible dividends to the extent that they have a GRIP balance, but everything else is going to have to be a non-eligible dividend because there's just no other pool balance that would support anything else as an eligible dividend. For a CCPC, sorry, for a non-CCPC, rather, a non-CCPC can pay unlimited eligible dividends, except to the extent that it has an LRIP balance. If it has an LRIP balance, that's a blocker, and the non-CCPC will have to pay non-eligible dividends until it exhausts its LRIP balance, at which point it can resume paying all the eligible dividends that it wants.
Okay, thank you. Just wanted to check.
Yeah, for sure. So I think you've got that right. That's sort of my way of conceptualizing it. So do we have anybody else, or shall we move on? All right, seeing none, we can flip to slide 14. And so slide 14, we're going to talk about here designations and excesses. So when I said that bad things happen if you pay an eligible dividend when you weren't supposed to, now we're at the part where bad things start to happen. So, first of all, in order to distinguish between eligible and non-eligible dividends, we need rules. Right? It can't just be inside the head of the director of a corporation whether the dividend is an eligible dividend or a non-eligible dividend. We need some way of sorting these things out. And so a corporation that pays an eligible dividend has to make a designation contemporaneous with the payment of the eligible dividend that the dividend is in fact an eligible dividend. And so if you don't have the designation, you don't have an eligible dividend. So this is true even for public corporations. Although what the CRA administratively allows is that any public corporation whose shares trade on an exchange can just put a statement on its website that any dividend is an eligible dividend unless otherwise noted, and then the CRA will treat that as a valid designation of the dividend. So that's what everybody else says. CRA does not allow other corporations to do that. So if you have, for example, a private corporation with so much taxable capital that the small business deduction is ground to zero, and so all of its income is general rate business income, and so it will have GRIP equal to what the dividends is paying, the CRA still does not permit you. CRA just still does not permit you to do that. You can't just say every dividend is an eligible dividend. You actually do have to designate it every time you pay the dividend, or you don't have eligible dividends. So, like I said, if a corporation fails to designate the dividend as an eligible dividend, then the result is that the dividend is just not an eligible dividend. It becomes a non-eligible dividend. So the result is that if you fail to designate the dividend as an eligible dividend, then there's no GRIP reduction. So if you have a CCPC, the GRIP is not reduced by the amount of the failed attempted eligible dividend. But the result is that your shareholders are going to be taxed on a non-eligible dividend, so they're not going to be thrilled by this result, especially if the corporation has finite assets. And so the failure to actually designate the eligible dividend means that it's not just a timing issue, and they've just simply been overtaxed. So that's not great. Somewhat fortunately for taxpayers, a few years ago, subsection 8914.1 was added to the Act, and subsection 8914.1 permits the designation to, permits the minister, or in this case, the Minister of National Revenue, aka the CRA, to accept a late filed designation of an eligible dividend in circumstances where it would be just and equitable to do so. So this is obviously very good news, where people forget to make the designations, etc. But I don't think I have ever seen the minister exercise that discretion favorably. I don't know if we have, as a firm, have ever had a situation where we've convinced the minister to exercise that discretion in someone's favor. So my takeaway would be that you should probably not rely on subsection 8914.1. That it's probably not going to be available to a taxpayer of any degree of sophistication. The CRA is not going to exercise discretion in favor of that taxpayer. So, assuming that we do have an eligible dividend, then, what happens if we have a dividend that, in the case of a CCPC, exceeds GRIP at the end of the year, or in the case of a non-CCPC, was paid at a time when there was an LRIP balance? Then, if you've done that, you have an excess of eligible dividend designation as defined in subsection 89.1. And what happens with an excess of eligible dividend designation is you have Part 3.1 tax under subsection 185.1 sub 1, and that's equal to 20% of the excessive eligible dividend designation. And in fact, that number can go higher. It can go to 30% as well if the excessive eligible dividend designation was the result of an attempt to artificially manipulate either the GRIP or LRIP balance. So artificially increase GRIP, artificially decrease LRIP. Then there is a potential that the 20% tax can become a 30% tax. Hasn't actually been any reported case where that has happened, but CRA and the Department of Finance do have some administrative examples of where that 30% hit should apply. So if you do find yourself in this situation where you have an excess of eligible dividend designation, then there is some relief. You don't just have to pay the tax. The corporation and its shareholders who received the excess of eligible dividend can elect under subsection 185.1 sub 2 for the excessive part of the eligible dividend to be deemed to be a separate dividend that is a non-eligible dividend and that was received at the same time that the original eligible dividend was received. And so the remainder of the eligible dividend that was not, the portion that was not in excess of GRIP if it's a CCPC, or the portion that was in excess of LRIP if it was a non-CCPC, that continues to be an eligible dividend, continues to be received by the shareholders who elected. It's just the excess portion that gets redesignated as a non-eligible dividend. So that's great. Obviously what that, and generally speaking, given that the rate differential between an eligible dividend and a non-eligible dividend is, it's about 8% in Alberta. It generally ranges in other provinces, but let's call it approximately 10% in most other provinces as the gap between the eligible dividend and non-eligible dividend rates. So it's and that's at the top marginal rate. So obviously it's in most circumstances much better to elect under subsection 185.12 in order to get out of the Part 3.1 tax. However, because you need every shareholder who received the dividend to elect, that can be really difficult to accomplish if you have a widely held corporation or if you have shareholders who receive the eligible dividend who are recalcitrant. So for example, if you bought out a shareholder on fairly hostile terms because your unanimous shareholder agreement allowed you to do it, and that person is now waving the bird at you when you ask them to make an excess eligible dividend designation, not much you can do, right? So it's usually a very good idea to make sure that you have enough GRIP to pay the dividend before you do it. And so obviously this takes, like I said, a little bit of forecasting to try to figure out what your end of year GRIP is going to be. But make sure you have a pretty healthy margin of error on that forecast, or really dig in and make sure you don't have an LRIP balance if it's a non-CCPC. Obviously, as you would imagine, a public corporation is never going to make this election if they pay a dividend in excess of, if they have LRIP at the time that they pay an eligible dividend, they're just going to eat the 20% tax. But for a private corporation, you would really want to elect. And so, functionally in real life, there's two ways that people will deal with this. If it's not a situation where all of your shareholders are members of the same family, where you can reasonably expect that people will either enthusiastically or ashamedly sign on to your election if the CRA ever comes knocking, two things. One is that you can have the shareholders consent to an election at the time that you pay the dividend. And then if CRA comes and says, okay, we need the shareholders, you should elect because you've paid an excess of eligible dividend, have the shareholders elected, and he would say, yeah, here you go, point to the resolution where there's an appendix on it that says we all elect. And hopefully the CRA will accept that as an election, even though it's not contemporaneous with the election, it's contemporaneous with the dividend. We have tried that. I don't think CRA has ever pushed back too hard when we've done that in real life. So that's probably a not terrible solution to the problem. The other solution, and which is the real, again, the very real world solution, is that nobody has ever forward dated an eligible dividend designation out of a CCPC. I don't think that has ever happened they're almost always backdated. And, which is theoretically bad. I'm sure whoever teaches you legal ethics would have something to say about that. I think the Department of Finance set themselves up for that, though, by making GRIP an end-of-year calculation and tying eligible dividends to GRIP, and then imposing a penalty for excesses. You create a situation where everyone's going to do the safe thing, and they're going to wait until kind of February-ish when they have an estimate of the corporation's tax payable and a final estimate of its taxable income, and then they're just going to backdate an eligible dividend resolution, which, I don't know that people should feel super bad about that. Obviously, it's not what you're supposed to do, but that's the real world solution. And I think, number one, finance and CRA know that everybody does that, and number two, that's finance's own fault for how they design the legislation. So any questions on dividends, dividend designations and excessive dividends before we move on? Okay, seeing none, I have 151 here. So I think this is a good time to take a break. We'll take 10 and come back somewhere around 2:01-ish. As a heads up, I may have to end the meeting and restart it, just because my Surface is not presently recognizing its power cord and I may need to reboot. So if the meeting terminates, just wait like 30 seconds and I should restart it. So please bear with me. In any event, I will stop recording now and I will see you in 10 minutes.